It's hard to believe that 10 years ago, Amazon introduced the Fire Phone, which was a complete flop, and it lost a ton of money. But since then, Amazon stock has gone up over 1,200% in the past 10 years. So that $10,000 invested with Amazon in 2014 would be over $120,000 today. But if a person used the rule of 40 to decide if they should invest in Amazon back then, it would have told you not to invest. And as a refresher, the rule of 40 states that for software companies, if you add up their revenue growth and their profit margins, and if it's equal to or greater than 40%, then it's a healthy company to invest in. But in 2014, Amazon's revenue growth was at 20%, and their margin was only at a negative 0.27%. The rule of 40 would have guided you not to invest in Amazon. And that's the flaw with rules like this when companies are in their startup mode or they're just about to explode in growth. That's why I'm going to cover my top 5 stocks to 10x within 10 years, where I try to balance out the financials along with the art of choosing companies that are going to fulfill a customer need that may not even exist yet. And I'll give you my disclaimer right from the beginning that I may be wrong on 70% of these, but I'm only banking on having a couple of them right. Now, I'm making this video because it was requested after I had reviewed the top analyst picks that were going to make us all millionaires, where I dissected those companies apart using mostly common sense. And the link is right up here if you want to check that video out. And true to form, I'm not going to keep the list a secret. You can always ditch the video right after I give my list, but the real value is seeing why I picked them in the first place. My list of 10 bigger hopefuls is D-Wave, Summit Therapeutics, Archer/Joby, Viking Therapeutics, and Palantir. And I'm also going to throw in a bonus one, which is a company that's going to have its IPO in the next 2 to 3 months and is one of the few IPOs that I'm actually excited about. So there it is. That's my list. If that's all you want, it's not going to hurt my feelings if you completely ditch the video and if you also don't want to give me a like or a subscribe. But if you do stick around, I think it's truly worth hearing why they made my list. Similar to my prior video on 10 beggars, I'll rate them from 1 through 10, with 10 being the best score for the 3 areas of market cap, fundamentals, and the future potential. And I'm the first to admit that there is a lot of subjectivity that's baked in. So feel free to share your opinions if you believe that I've missed something. The first company I'll speak to is D-Wave Quantum with the symbol QBTS, referencing qubits, which develops and delivers quantum computing systems, software, and services worldwide. The company's quantum solutions are used in scheduling, mobility, logistics, drug discovery, portfolio optimization, and manufacturing processes, where they recently unveiled a 4400 qubit Advantage 2 processor that touts having a 40% boost in energy scale and doubling its coherence time. And this is several times larger in qubits than any other quantum computer right now. And I'm not going to get too technical, but quantum computers are able to process enormous amounts of data and models that are hundreds of years quicker than traditional computers. Granted, they won't replace traditional computers, which means that this technology, well, it's only going to be accretive to all other technological advancements. And when we look at the performance, it's up over 63% year to date. But bringing us down a notch, it is down negative 88% from its IPO in 2020. So be thankful, I hope, that you didn't invest in it 4 years ago. But in using some common sense, I love that the market cap is only at $290 million, which means that if this company grows 10 times or 10x's in 10 years, then the market cap would be $2.9 billion, which is extremely realistic. But when we look at the financials, it's obvious that this is a startup, and the fundamentals tell me this is not a stock to invest a whole lot into. They are burning through cash, and their debt to assets is very high. The only upside is that they have several beats to the estimates in the lower right quadrant. And analysts are giving D-Wave some love with a 53% upside for the forecasted next 12 months. And here's my rating for D-Wave under my 3 main criteria. So for fundamentals, I only give them a 1. Market cap, they're at the top with a 10, and future potential is also a 10, giving it a total score of 20. Just kidding, it's a 21, but I'll probably say one of them wrong just to see how many people are going to comment on it. Overall, this stock is touching on future technology that isn't widely adopted or available to most of us. But it is priced low enough right now that I'm willing to invest a few thousand into it and just ride it out for the next decade. The next company to review is Summit Therapeutics, which is a biopharmaceutical company that's on the radar for their cancer drugs that are tackling non-small cell lung cancer with their drug, well, I'm going to put it on the screen because I really don't want to murder it by how I would pronounce it wrong. But the drug is different from others because, well, first off, it blocks PD-1, which enhances the immune system in order to fight off cancer cells. And second, it inhibits VEGF, which helps prevent the formation of new blood vessels that happen to be feeding the tumors. In essence, it comes with a 1-2 punch that other drugs like 𝐞𝐬 just don't offer. The drug is on a fast track with the FDA, so approval might be 1 to 2 years out. It has shown a high efficacy by reducing progression and death by 49% compared to the competitor's drug. In looking at the performance year to date, it's kind of ridiculous, up 720%, but it does have room to grow. The market cap is at $16 billion, so it is within our window of opportunity. Unfortunately, this is a purely speculative stock because, yes, they do have product in trials, but they don't have anything today that's driving revenue in sales. So it is totally in its design and building stages. Everything is banking on FDA approval, but since they received a fast track, in my mind, that's encouraging. Because when we look at revenue, it is a big hole, and the debt to assets is increasing at a slower rate, and investors are its only form of cash flow. But they are managing costs well, which is showing in the earnings per share, which is negative, but it does show that they are managing their business within a smart window of expectations. And the analysts are giving Summit 58% goodness in their projections for the next year. In breaking this stock down under my criteria, for Summit, I give it a 1 for fundamentals because, well, they are managing their costs, but they aren't selling anything yet. And I give the market cap a 10 because if it were to 10x in 10 years, that would put it at $160 billion, which is realistic considering the competitor's drug 𝐞𝐬 is generating $25 billion a year. And since they had stellar results in trials, I'm giving the future potential a 9. I would have given it a 10, but everything hinges on that FDA approval. This company has great upside, but without having a physical product generating income today, then it's difficult to want to invest a ton of money right away. So it's a good one to cost value average, in my opinion. Another way that I like to diversify and try to 10x my investments is by owning my own business. Then there is an option that pays 7 to 9% a month on invested capital. That's where today's sponsor, Limits Express, comes into play. They work as business managers to create and manage an Amazon store just for you, where they buy and sell national branded products using your capital and business. They do all the heavy lifting and all of the day-to-day work. They don't get paid unless your Amazon business makes a profit. In full transparency, I have invested with Limits Express to vet them out and to verify their process. My first 2 full months of sales came in at just over $12,000 with nearly a $1,200 profit. So that's a margin of 9%. I admit that the process starts off a little bit slow because you need to get approvals to sell the brands, but that's due to Amazon and its processes. So if you're interested in learning more, I'll have a link down in the description so that you can speak directly with Kyle, which happens to be one of the co-founders. You can also check out their website down in the links below. And please keep in mind that all investments carry some level of risk, and this is not a personal recommendation. Now we'll get into one of my favorite companies, Palantir, where they are a software company with a truly unique AI model built from the ground up. And I truly hope that you saw my videos last year where I was trying to get the gospel out that Palantir has an incredible product, and their profits and their demand, well, they're going to skyrocket with their shift to more of a commercial customer. Truly, they have the most innovative AI product that I've ever seen, where it automates and it improves a company's entire enterprise software solution. In fact, in a recent case study, Wendy's partnered with Palantir when they used it to leverage for their supply chain and for forecasting features, where they instantly saw a competitive advantage from the software. And they've already stated that the ROI has been significant. Now, when we look at the performance, it is up over 251% year to date. And I fully expect it to still have many dips here and there where we'll all get the chance to buy more. Because when we look at the PE ratio, it is an insane 256. So it's pretty obvious that there's a lot of expectations baked into the price. And the financials begin to tell us why the expectation is so high. The revenue, earnings, and the profit margin have all been on a constant climb. And that's the message I was showing last year when I was trying to share the fact that once they break over into positive earnings, the stock is going to take off, which it did. And then there's the debt to assets where it has dropped off a cliff, which is completely awesome to see. And the cash flow picture looks steady except for the investing. And then there's the beat to forecasted earnings per share consistently each quarter on the lower right side. And when you bring this all together, It's no surprise that this has been a Cinderella story all year. Analysts aren't seeing upside for Palantir, seeing as how they have them down negative 43% for the next 12 months. However, I have a very strong feeling that analysts will be changing their forecast over the next couple months, giving Palantir a little bit more goodness than what you see right here. And once again, just my opinion. So when I break down Palantir's score, for fundamentals, I'm giving them a solid 10 because they're hitting on all cylinders. And for market cap, I'm going to ding them and only shell out an 8 because to 10x in 10 years, they'd be about a $1.4 trillion company. And don't get me wrong, it's completely doable, but that's assuming that their demand will keep increasing at this current pace or more. And when it comes to future potential, Palantir doesn't really have any competition that comes anywhere close to the complex level of its systems that they offer today. Once they can push ahead with marketing and distribution, then they can blow up even faster. And I love the fact that they're showcasing their wins on the commercial side and not just their government contracts. I had already come to the conclusion about a year ago that Palantir was going to be part of my Elite 8 investments. And you can easily see that when you look at my portfolio that I share in my newsletter. Before moving on to the next company, I do want to mention a bonus company that I am actually excited about with their upcoming IPO. And that would be Cerebras, which is a semiconductor company that is in huge demand because they're creating their wafer scale engine with 4 trillion transistors and over 900,000 AI optimized cores. They have a lot of customers, but so much of the information on the company happens to be private. So there isn't a lot of information that we have access to. However, the word on the street is that they plan to go public in the next 2 months. And I simply want to get it out on your radar. And I have to admit that I often don't like IPOs, and this one is also going to depend on how the valuation goes. But overall, I see this one as a ton of potential. So I'm just throwing it out there so you know it exists. The next company is Viking Therapeutics, which is a biopharmaceutical company focused on developing therapies for metabolic and endocrine disorders. They have a GLP-1 drug in trials for an oral pill form that will greatly expand the weight loss drug offering. And also they have one in the form of injections like those that are already on the market. In addition to these, they're also completing trials for thyroid metabolic disorders for more diversity within their product offering. Viking does have a lot of momentum so far at over 240% return year to date, and they are up over 1,000% in the past 3 years. Their market cap is $7 billion, so that's definitely within our window. And they don't have a PE because, well, they don't have any product on the market yet. This is another one of those speculative stocks where they do have a product within trials, but they don't have any products launched to actually generate revenue. That's why when we look at the financials, the earnings are negative leading up to the launching of the product. But thankfully, this is another case where the company is managing their debt to assets quite well in the upper right. And their cash flow, well, that really doesn't tell me much. But their earnings per share are beating expectations because they happen to be managing their expenses well. I'll quickly point out that analysts have Viking with a 12-month forecast of a 79% upside. So when breaking down Viking Therapeutics, I give them a 2 for fundamentals because they are still in that speculative startup mode until they have FDA approvals. As for market cap, I give them a 10 because they have a long runway given the breadth of drugs that they have in the pipeline. And for potential, I give them a solid 9. I'd love to give them a 10, but the reality is there is a lot of competition in this space. And the next company is Archer Aviation. But quite honestly, you could probably choose either Joby or Archer, and I feel that they're both going to be very similar in standings. But for me, I lean a little bit more towards Archer, where they design and build electric vertical takeoff and landing aircraft meant for urban mobility, or relatively short distances between 20 to 50 miles. And they have a 400,000 square foot production facility in Georgia that's going live in the next month or so. And they plan to produce 2 aircraft a month in 2025. But they will have capacity to make 650 aircraft a year once they're at full capacity. And the next major hurdle is in the FAA certifications, which they hope to complete the 4th phase next year with the potential of having commercial flights by the end of 2025. Now, I've spoken about Archer a few times in the past, and a lot of people have pushed back on the battery limitations and also safety. And I believe those are fair concerns, but batteries aren't going to stop it from making short flights that it's intended for. And as for safety, these eVTOLs have more safety redundancies than you see from any helicopter out in the market. But since it is not in full production and it hasn't even completed all of its FAA certifications, we don't really know all the details on safety or what to expect. And I have to say, it's not a rosy picture when we look at the performance year to date at a negative 26%. But the momentum is truly going to kick in between now and when they they start commercial flights in 12 to 18 months. I can genuinely see this as a company where people will be kicking themselves for not buying it when it was just $3 a few weeks ago. But for the extremely logical person out there, when you look at the financials where they're still ramping up the business without having any positive revenue, it's not a stock that you want to get too excited over. And the debt to assets is growing quickly as they prepare for production. And I can't read much from the cash flow since it's all investor capital. But the beating of earnings per share to forecast, well, it's pretty good because they are ahead of expectations. And the way that analysts are viewing Archer, they have them with 119% upside for the next 12 months. So how exactly am I going to boil this down for Archer? Well, for fundamentals, I give them a 1 because it's a high capex company that's still waiting on FAA approvals. And for market cap, I give them a 10 since they're only at $1.6 billion today. And to reach $16 billion in 10 years, honestly, I think that's extremely achievable. And as for potential, I give them a solid 10 because it's at the very beginning of the race, and there's only a few companies like Joby and XPeng that are in the running. So when we compare all of these companies at once on the screen, they would rank from top to bottom to 10x in 10 years based on my subjective scoring. It would be Palantir with a 28, Archer 21, Viking 21, D-Wave 21, and Summit comes in last at a 20. I'm guessing that there are several of you out there that are going to disagree with my selection or even my scoring. And that's okay. Feel free to drop your thoughts and your ideas down in the comments so that others can hear what you think and point out anything I may have missed. And I know that many of you don't like the risk that's associated with individual stocks, so I highly recommend that you check out one of my other videos on high growth ETFs. Thanks so much for watching.